Hello, everyone. Welcome to today's video production here from RSG. I'm Kevin Delaney, Vice President of Business Development. I am joined by our CEO and founder, Mr. Steve Scott, AIF and CPFA here in the investment community. And we also have our Chief Investment Officer, CFA himself, Mr. Frank Sabin, joining us for today's delightful conversation. So today, gentlemen, we just wanted to get something out to our participants. Popular buzzword today, something you might have heard of years and years ago, but the T word, as I'm going to call it, because everybody's got questions on tariffs. Obviously, there's been a lot of volatility that's come about with the idea of tariffs. So, Steve, I just wanted you to level set for our participants. What in the heck is a tariff?
Yeah, and I'm going to keep it really simple and storytell because, I think like a lot of things, we can get into the weeds with it, but what really I think most of our participants care about at the end of the day is what is it? What does it mean to me? At the end of the day, it's a tax. And it means if you're bringing a good into this country, it's going to cost you an additional tax. And so let's just pretend, use BMW, obviously a German-made car, made in Germany. That vehicle is brought over to America, and now there's going to be an additional tax levied against it to come in. You either philosophically believe that BMW is willing to make less money for selling that same car and eat that tax, and or the dealer is willing to do that, or you believe that what will happen is some of that cost may be passed on to underlying consumers. And so that's a very, very high, very, very simplistic level of what we're talking about. And I use the BMW just because it's in, obviously everybody knows it's a German car, so coming in and the European Union has been part of it. But conceptually, that's what we're talking about. Now, there's a lot of other reasons on why we're doing it. These go back, a lot of them, a lot of these deals have gone back to early World War II. And, there's this whole argument, do a lot of them need to be revisited? Leaving that aside, at the end of the day, it's a tax to bring goods in. Somebody's going to have to pay for that tax. And what are the implications on economic growth, et cetera, I think is why this is creating such a market event.
Frank, do you have anything to add to that?
With respect to what the definition of a tariff is, Kevin, or from an investment standpoint?
Yeah, just from an investment standpoint.
Sure. One can have a PhD, Kevin, in economics, and this would be appropriate grounds for them. But the reality is, let's just do it from an investment 101 standpoint,
sure.
Which the market does not like uncertainty. And the tariffs that were expected vis-a-vis what's happened are much greater in magnitude than what was expected. And it's really that uncertainty that's driving market volatility. There's the real effect, and then there's the surprise effect. And it's really the surprise effect that's rattled investors.
Yeah, well said, Frank. That surprise effect. Steve, I hear you talking about tariffs sometimes when we discuss it as a black swan event per se. Something that's outside of the norm. So given that this is outside of the norm, can you just simply bring to light, like, what are the key effects on somebody's retirement account and long-term savings with regards to this event?
Sure. And many of you who listen to this right now have listened to me yap over many years. A black swan, for anybody who is newer to the conversation, it's a phrase we use in the investment community, people like Frank and myself, for a long, long time, where you just say an event occurred that nobody could have planned for. So a really basic example of that would be like 9/11, right? There's nothing economically that was going on. There's nothing in any kind of legislative policies or whatever. It just, terrible event happened, and it changed things for a while. And of course, that's what we call a black swan. Like, nobody expects to see a black swan when you go to a pond. Nobody expected 9/11 per se. But let's go back to the last black swan event we had, and that was, of course, COVID. What I think is really important to people is that our messaging, and Frank and I were doing this together during that whole process and put out a lot of communications during that period. And our communications usually in the early phases of it, mostly in March April, etc., was to really be patient, not overreact, curtail emotions. We need to wait and see. So it's a lot of wait and see in the early stages of any sort of a black swan. And while I do think this is somewhat of a manufactured black swan, I'm the king of stupid analogies. I keep saying it's like somebody went to the pond and found a swan and picked it up by the neck and threw a bunch of black paint on it, whipped it back in the water and said, look, there's a black swan. Because this one feels a little bit more manufactured than these other examples that we're talking about. But it still is, at the end of the day, following that recipe of saying, as Frank's already alluded to, high levels of uncertainty. This event is bigger than was anticipated, and therefore we need to be a little bit in a wait and see approach for now. Now, I want to also go to finish this thought by saying, by summer of 2020, Frank and I, and I think many other investors, but at least as the two spokespeople really for RSG, had an opinion that the way the US was responding was more aggressive and more targeted than a lot of the other countries in the world, and that we thought the US would come out quicker and stronger. And as a result, we did shift asset allocation strategies to be more US centric in that period. So my point is, it's not that you just wait and see in perpetuity, it's you wait and see during the initial chaos and confusion. And then once you start to have a little bit more of a game plan, you make the necessary adjustments. And again, I think COVID's a perfect example of us bringing that messaging to participants as we started to get a little bit more data. And I expect that we'll be in the same situation here.
So at least wait and see for the next couple of months based on all the volatility that's happening. That sounds to be your best advice right now, Steve.
Yeah, I think so. I think there's still, again, there's a heightened sense of volatility, heightened sense of uncertainty. With that, there's a heightened sense of volatility. I think this could obviously play out a lot of different ways. This could go for quite a while, but I do think that there will be elements of clarity. My personal opinion I don't know facts, no insider track to this, but I think you'll start to see a few deals announced and some folks, in the administration, people who've been big fans of the policy to say, see, we're making progress. And I know there's been a lot of stories that Japan's been actively negotiating and Italy's been actively negotiating stuff. And, that's good. And there will be this, again, period of maybe the market will really jump up because of those announcements. But ultimately, we need to see how this is going to play out in a variety of levels. Obviously, China is our biggest challenge in this department and has the biggest impact, because anybody who has walked through their house recently, I just challenge you to look to how many things are made from Italy and how many things are made from China. Just go walk through your bathroom. It's not close.
Sure.
And so I don't think we'll have all the answers in the next month or two, but I think we'll start to get a little bit better game plan on where things are going, and then can build strategies around that. But this will probably be fluid for a while.
Okay, that's great. Thank you. And is there any actions, Frank, that you feel like a retirement saver should be taking right now to just stay on track to their retirement goals, given the volatility and given all of the tariff announcements strategically?
Yeah, I mean, I think it's about first principles, Kevin. So the first step is let's make sure that you know what your at the highest level what your risk profile looks like. So that would be your allocation between stocks and bonds as a first level consideration. Number one. Number two is within that is your broad mix of assets. So your diversification. What does that look like? Does it have breadth to the allocation? So investors would do well to know sort of those broad questions. One, what is their risk profile, and then two, are they broadly diversified? What I would say is, and really important here as a reminder, it's always important when investing, is these assets, Kevin, are going to last for decades, right? For the rest of your life. So the strategy is not a strategy for the next 3 months. The strategy needs to be for your next 30 years.
Good point.
So that's really, you got to match the goal, the strategy to the goal, and that goal is a 30-year goal. In terms of, Steve, I'll go to what you said, which is really, very interesting, is this whole black swan consideration. The black swans have historically been, the one in a century type of an event. Really what we're seeing now is that we have these quote unquote black swan events every 5 years. So I think that's the world that we find ourselves in now, is a black swan every 5 years. Pandemic, financial crisis, 9/11, this, right? And so the temperament of investors needs to reflect that as well, and the strategy needs to reflect that. We did come into the year with a sense of elevated volatility and risk, but it's been even more pronounced certainly than what we had expected. But it just means that we have to redouble our efforts with respect to diversification, thoughtful rebalancing, and keeping our heads cool. Those are the three elements to our strategy right now.
Okay, I like it. Steve, do you have something to add?
Yeah, I do. I actually think Frank made a lot of really good points there. Number one, just friendly reminder to everybody, anybody who went to our market outlook at the beginning of this year, we did talk about a significant increase in volatility in 2025. That was driven by the fact that the markets were at a significant, coming off 2 strong bullish years, that we thought there'd just be some profit taking. Number two, not to say good, bad, or indifferent, but the just significant delta between the 2 administrations, and this idea that there was going to be this really strong change narrative. And that's where I think tariffs falls, right? Going back to that. And then 3 was this story that Frank and I have been talking about for, I'd say, well over a year now, at least a year and a half, on this S&P concentration, and the fact that big tech has really kind of taken over the world's largest index in such a large part. All of those things, led to this idea that we were going to be in a more volatile period. And now here we are. The one good thing about it, next month will be my 30th year in the investments and retirement industry, which is painful to say out loud. But, I've been through a lot of these, right? I've been through the financial crisis, 9/11, COVID, all the things Frank just talked about, as has he. And my point is, the one good thing about these moments, this is the gut check. Like, you're either at the right risk level or you're not. And it's one thing to say that when we've had 2 years in a row of the S&P being over 20%, and to say, no, I'm good with 90% equities. It's another thing to say it when we start to trickle on that negative 15 to 20%, right on the line of the bear market, and say, are you still okay with it? And there's 2 things. There's some people who just have a very emotional reaction anytime they lose money. There's another thing, that we have obviously an aging population, a lot of people getting closer to retirement. And when you are in that spot, I say this as somebody who's 52 now, who sometimes we have to remind people, smart people, very successful people, really basic math. And part of that is, when you have a larger account, a 20% drop is still just a 20% drop. It just feels a lot more, right? And so this is the gut check. After 2 incredibly positive years, to say, is my risk level appropriate, or is this too much? And if it's too much, that's fine. We don't want you to react when we're in this highly unclear period, which is where we think we are still right now. And that's why we're saying, let's revisit it in a couple months when we have a little bit more clarity. Not that we want people to market time in any way, but if there's a need to adjust this asset allocation on the going forward, to make sure that 30-year strategy is appropriate, because as Frank just properly alluded to, we think there's going to be more of these. We think this is this strange new norm, that they seem to be happening with greater frequency than they did in the past.
Yeah, great points. And so last thing for you guys, but if I'm somebody who's 3-5 years away from retirement, and like you said, Steve, 20% declines has got my eye, is there anything that I should be thinking of differently than somebody with that long-term horizon of investing to just get through this troublesome market?
You want me to go first on this one?
Yeah.
I'd say some of it is the stuff I just alluded to. Number one, again, going back to the basics, as Frank kind of alluded to in the very beginning. you're still a buyer for 5 more years. When markets are down, it's a good thing to buy. We all know that is a concept, but it's hard to sometimes remind yourself in the moments when you look at an account statement that's got a negative number associated with it. But remember that number 2 is that the day you retire, you're still a long-term investor. The majority of your money is still going to be there, as Frank alluded to, for 20, 30, 40 years, right? So you still need to have a solid equity allocation and understand that volatility is part of that game, and you do not need all of those funds tomorrow, the next day, the next year. So as long as you have that proper perspective, I think that'll avoid some of those decisions. And then the third and the final thing I'd say is, I know I already alluded to the gut check, but you do need to make sure that your asset allocation is not built around having a number that beats a friend at the barbecue or beats your brother or your cousin who never shuts up about investing, right? And bought NVIDIA or something like that. Like that, instead, it's what's appropriate for you. And there's no right or wrong then. I don't care what designations and what years of experience I have or Frank has. I'm not saying my approach is the right thing for any participant. Only you know what's right for your participant. But I will tell you, these are the times, particularly for the people closer to retirement, that I think you can do a gut check and to say, maybe the next 10, 20 years is less about getting as much of the market's upside, and it's more about controlling some of the market's downsides. And that's got to be a personal decision.
Okay. And then Frank, any last thoughts?
Yeah, I mean, something that we didn't raise in this conversation is investing is all about probabilities and likelihood of success. That's really what our portfolios are built on. And along those lines, one of the primary strategic imperatives as investors is not to time the market, because it has really bad odds. And the odds, you have to see the numbers to believe them. Steve referenced our recently published letter, and in it, what we saw is that from over the last 20 years, somebody that just didn't time the market, stayed in the market, would have had the S&P 500 an annualized return of 9.7%. Had that same investor just missed the top 10 best days, their return, Kevin, would have dropped to a whopping 5.5%.
Wow.
Worse is an investor that missed the 40 best days. That investor would be down negative 1.2%. So, first principles here. Be very, or use the probabilities, odds, to your favor, and always remember that in terms of how you deploy capital, and just have that in the back of your mind. It's very tough to time the market, and one does it at great risk.
Yeah, that's a great point, Frank. I mean, just trying to time the market, you miss those days back up, right? And they wrote it down, and so then one might go to cash or stop deferring altogether, and then they miss those best days coming back, which is a huge detriment to their end balance, through those scenarios. So again, guys, for any of our participants, tariffs are here. They aren't going away. How you manage your account is up to you, but through our guidance, we offer tools, resources, and support through your relationship manager, Steve, myself, Frank. We're always available here at RSG, as well as your lead consultant. So just accept the fact that tariffs have presented a larger reality for us, and it's an opportunity, like Steve said, it's a gut check opportunity to take a look at your balance and your investments and make sure that you are allocated and diversified properly in this current volatile market. Steve, any last thoughts for our audience before we wrap up here?
No, I know it's sometimes hard to do, but these are the times that if you can save a little bit more, you should, because the buying side is the part that we're winning, number one. Number two, as Kev just said, we have a lot of resources here. Every single member, every single one of our clients has a lead consultant that's associated with it. So you get support whenever you reach out and need it. Many participants, the statistics I've heard are as high as 80% potentially, have monies that have been left behind in other places. And they likely are not getting that level of support. And so during these times of uncertainty, it's good to consolidate and pull it together and make sure that you do have that support where you need it, and that you know where your money is. I mean, it's your money. Be engaged. That's one of my biggest parts of this messaging.
Love it. Well, gentlemen, obviously a heavy topic today. Very enlightening conversation. Frank, I thank you for your time. Steve, thank you for your time. And to all our participants,
Thanks,
hope
guys.
this was useful for you.
Thanks, Kev.
Take care. Thanks.